I've recently come across a very interesting company from manufacturing sector. It is India's leading forging company and now trying to transform itself from a traditional auto component manufacturer into a much broader engineering company with exposure to passenger vehicle, electric vehicle, railways, aerospace, and even global markets. Well, I'm talking about Ramakrishna Forging. If you look at its share price over the last 10 years, it has been a complete roller coaster ride. Its stock price jumped almost 3 times between 2016 to 18, then went through a brutal correction. Then from COVID lows, it delivered more than 30 times return. But then its stock price tanked more than 50% from the peak. And now after the Q1 FY27 results and management con call, the stock has once again started moving up. Although it is still well below its previous highs. Question is, what exactly is happening with RK Forging? So in this video, we'll start with business of RK Forging, then understand the reason behind massive stock rally and subsequent correction. We'll look at what is changing in the business and the key growth driver along with management guidance and key risk. And finally, we'll look at the valuation. Because if you simply look at the P ratio, it is showing more than 100. But that can be misleading. I'll explain it. Just one disclaimer before we begin. This video is not a buy or sell recommendation on the company. Ensure that you do a thorough research before investing your money. And if you don't have the right knowledge or time for research, first build that knowledge. I also help with research part in my weekly video series where I track nearly 200 companies and share my own investment thesis. And if you don't want to learn individual stock investment, better avoid it and stick with mutual fund. Alright, let's get started. Before we understand the reason behind stock volatility, let's quickly understand RK Forging business model. So it is basically a forging company. In fact, it is one of India's largest forging player. Now, what exactly is forging? Let's take an example of a truck. It needs components like axle beam, steering nickel, transmission part, shaft, and other critical components. RK Forging manufacture these components through a process called forging. Basically, company takes steel or other metal, heats them, and then uses very high pressure to shape them into the required component. It then does processing like machining and heat treatment to make the finished component ready for the OEM. Obviously, it is not a fancy business. Now, historically, company was heavily dependent on commercial vehicle segment, particularly trucks and buses. But over the years, it has expanded into passenger vehicle, railway, mining, industrial application, and export. In fact, company is expanding its capability and entering into new exciting sectors that we will discuss shortly. Now let's first understand the reason behind more than 30 times jump between April 20 till September 24. So the first thing we need to understand is that 2020 was an unusually low base. COVID had severely impacted automobile industry. Commercial vehicle demand was weak, production was disrupted, and there was lot of uncertainty around the entire auto cycle. So when the economy reopened, there was a sharp recovery in vehicle demand. And RK Forging was in a very good position to benefit from this recovery because commercial vehicles were its core market. But the story was not simply about volumes coming back. The much bigger story was operating leverage. So RK Forging has a capital intensive manufacturing business. Company has to spend heavily on plants, machinery and equipment upfront. But once the capacity is available, producing an additional component does not require the same proportionate increase in fixed cost. So when the utilization starts increasing, your revenue grow much faster than fixed cost. And we can actually see this clearly in number. RK Forging revenue increased from around 1200 crore in FY20 to 3700 crore in FY24. More than 3 times jump in 4 years. But EBITDA increased from around 29 crore to 774 crore, almost 4 times. And EBITDA margin also expanded from 17 to 22%. And this is exactly what the market loves to see. Revenue growth combined with better capacity utilization resulting in operating leverage and hence faster EBITDA growth and much faster profit growth. So company's PAT went from just around 10 crore in FY20 to 291 crore in FY24. But there was another important part of the story, diversification. During this period, company expanded its customer base and export presence and also increased exposure to railway and other non-auto application. If you recall, there was a massive boom for railway between 22 to 24 phase. And RK Forging benefited from that growth. Company also started building capabilities in areas like cold forging and casting. So in normal forging, metal is heated and then pressed into the required shape. Cold forging is basically a very powerful press to squeeze a piece of metal into a precise shape without heating it first. The advantage is that it can produce highly precise components with less material wastage. Casting is particularly useful for making complex shapes that can be difficult or expensive to produce through forging. So earlier, investors would think of RK Forging as a cyclical commercial vehicle forging company. But gradually, the narrative becomes this is a company with multiple growth engine, increasing exports, new capacity, and significant operating leverage. And when the market starts believing that future earnings can grow much faster than the historical earning, the valuation multiples can also expand. In fact, its PE expanded nearly 9 times from 10 to nearly 90. And that explains the reason behind extraordinary return from COVID lows to its September 24 peak. But the same factor that helped the stock price goes up 30 times also created the setup for eventual correction. The first issue was North America. RK Forging has meaningful exposure to North America commercial market, especially your Class 8 trucks. After the strong post-COVID rally, customers started destocking and demand softened. This impacted RK Forging export business and raised concern about how sustainable this earlier growth rate has been. The second issue was capacity utilization. RK Forging had invested heavily in new capacity, but some of those assets were still operating at relatively low utilization. So company had already incurred the fixed cost, but the revenue contribution was not yet large enough to generate the expected operating leverage. And this is important for a capital intensive company. Capacity creates potential growth, but until that capacity gets utilized, it can actually drag on margins and return. Then third issue was high expectation. After more than 30 times rally and valuation re-rating, market was expecting RK Forging to continue to deliver very strong growth. So any slowdown versus those expectations could lead to a sharp de-rating. And that's what has happened. Company's growth reduced significantly, EBITDA margin tanked due to operating deleverage, and eventually profit tanked badly. And that resulted in sharp de-rating. Now the question is, why suddenly market is excited with RK Forging? What is the latest development and what are the growth drivers? Let's discuss it. So in latest Q1 FY27 con call, management sounded very bullish. First of all, they are targeting 8,000 crore revenue by FY29. Please note that FY26 revenue is around 4,200 crore. That simply translates to 22 to 25% CAGR growth over the next 3 years. On margins, management did not provide specific target, but they expect EBITDA margin to improve quarter on quarter. In fact, management said that they intend to touch previous margin levels, which were more than 20%. They did not provide specific timeline, but they sounded confident of reaching peak margin in the coming years. More importantly, management is targeting 12 to 15% ROCE in FY27 and 20% by FY28. Now, what is the reason behind this bullishness? So, I have identified 4 key reasons. First is the shift towards higher value segment. Historically, RK Forging was heavily dependent on commercial vehicle. But the business mix is now changing towards passenger vehicle, electric vehicle and non-ferrous forging. For example, around 82% of 278 crore of new business won in Q1 has come from passenger vehicle segment. At the same time, aluminum forging have already entered into bulk production phase. Company is also developing capabilities in titanium, stainless steel, Inconel and so on for your aerospace, robotics and semiconductor sector. These products have significantly higher realization and can gradually improve the overall product mix. Management said that non-ferrous now becomes next lever of growth for RK Forging, but it will take 12 to 18 months before they get significant revenue from the stream. Then second driver is improving utilization. Company has spent a lot of money over the last few years on forging and casting capacities. But many of these plants are still not running at optimal utilization. Management want to take utilization towards more than 80%. And this is where I think the operating leverage can become quite meaningful. Company has already incurred a large part of the fixed cost. So as the volume goes up, your EBITDA can grow faster than revenue. That's also one of the reasons management expect profitability in ROCE to improve in the near future. Then third driver is export opportunity. Management expect exports to grow more than 20% and contribute around 35% of revenue in FY27. North America is particularly important because the Class 8 truck market, which was a major drag earlier, is showing signs of recovery. At the same time, Mexico facility has started production and management expects a meaningful contribution from Q3 of FY27. Europe also remains an important opportunity. So the combination of North America recovery, Mexico ramp up, and European growth can support company's overall revenue target. Then fourth driver is deleveraging. By end of Q1, company had a net debt of around 1900 crore and company want to reduce this by at least 500 crore during FY27. This is important because RK Forging is now moving from a phase where it was aggressively investing in capacity to a phase where it needs to monetize those investments. If EBITDA starts growing up while debt comes down, you get lower finance cost and better return ratio. That's how the company can potentially move towards 20% ROCE target by FY28. So when I look at 8,000 crore revenue target, I don't think management is relying on one particular trigger. There are multiple things coming together. Better business mix, higher utilization, passenger vehicle and electric vehicle growth, new business opportunity in aerospace semiconductor area, exports and deleveraging. The opportunity is definitely quite interesting. But now the key question is execution. Company has already created the capacity and entered into these new business. Over the next 2-3 years, we need to see whether RK Forging can actually convert all of this into sustainable revenue growth, EBITDA growth and better returns or not. Now that we have discussed the growth potential and management guidance that looks very promising, let's understand the key risk and growth thesis. So first risk is geopolitical and freight related risk. Management said that one of the key risks in their business is due to your geopolitical uncertainty, their shippings are getting delayed and that is putting pressure on working capital. Also, energy cost is another risk. So if US-Iran war escalate and energy prices jump, it can be negative for RK Forging from margin point of view. Steel prices can largely be passed on to customer, usually with 1 quarter lag. But freight and energy costs are much harder to pass through completely. Then second risk is the cyclical nature of the business. Even though RK Forging is diversifying into passenger vehicle, EV, railway, and non-ferrous product, commercial vehicles are still an important part of the business. And both the Indian and global commercial vehicle market can be quite cyclical. Although management is confident of demand in FY27 and expecting export to grow more than 20%, but this is one risk that we need to track closely. Then third risk is execution. There are quite a few moving parts to RK Forging story right now. Rail wheel, casting, cold forging, aluminium, Mexico, the new passenger and electric vehicle program. All these businesses need to ramp up smoothly. If customer approvals get delayed, production takes longer to stabilize or utilization does not move towards the targeted 80% range, then the revenue and margin targets could get pushed down. And remember, management 20% ROCE target by FY28 depends heavily on these new assets actually generating good return. Now let's talk about valuation. That would give you a good idea if company valuation is expensive, fair or cheap. So when it comes to valuation, majority of people simply look at PE ratio. But I've mentioned it multiple times that PE ratio can be misleading. In fact, I've done a couple of videos as well on this topic. So in case of RK Forging, its PE showing more than 100. At first glance, it is super expensive, isn't it? But here is the catch. The reason for more than 100 PE is due to slowdown in revenue growth and sharp decline in margin. As a result, company's profits have fallen from previous highs of 291 crore to now at 107 crore. Please ignore 415 crore profit because that includes 109 crore of other income and minus 80% tax. So basically, company's EPS has fallen from highs of 16.1 to 5.8. And due to sharp fall in EPS, PE ratio has become elevated. Just to give you an idea, if company can achieve its guidance of 8,000 crore top line and say 20% margin by FY29, its EBITDA would expand to 1,600 crore against FY26 level of 625 crore. Also, company is planning to reduce debt that would reduce the interest component. Overall, the EPS would expand significantly. So, your current PE ratio, that is trailing 12-month PE ratio, is not giving you a right picture. And that's where you should try to understand the forward PE ratio. You can even do financial modeling if you want and create a bear, base and bull case. For instance, if you take base case at EPS of 43, it is trading at 17 times FY29 PE. Now, obviously, these are forecast and it's a scenario based modeling. Company still needs to execute and deliver 8,000 crore target and the margin expansion. Other than PE, if you look at the price to sale, it has fallen significantly from the highs and even price to book is down significantly from the highs, near the median level. Then EV to EBITDA is reasonable. So overall, the valuation appears to be reasonable for the guidance company is giving. Now at this stage, you have three choices. First, you keep it in the watch list and keep an eye on execution. If company deliver on guidance, you take a position. But in that case, you might miss out buying from lower level. Second option is you take a small position now and wait for the company to deliver on their guidance for the next few quarters. Based on the result, you slowly build your position. Or third option is you take a shot now and keep an eye on execution. If they deliver, you get rewarded. If they fail in execution, you cut down your position. So ultimately, it comes down to how much conviction you have in the story and how much execution risk you are willing to take. There's no right or wrong approach here. So to sum it up, RK Forging is at an interesting transition point. Companies already invested heavily in capacity, and now the focus is shifting from capex creation to sweating those assets. If utilization improve, export recover, and your PV and EV business scale up and new business like aluminum and aerospace start contributing, there's a clear opportunity for earning to grow significantly over the next 2 to 3 years. At the same time, we should not ignore the risk. There is still a cyclical, capital-intensive business, and there are several moving parts that needs to come together. Your 8,000 crore FY29 target and improvement in margin and ROCE are management aspirations, not guarantee. And that's why for me, RK Forging is more of an execution story at this point. The valuation does not look unreasonable if management deliver on its target, but the market will increasingly judge the company on actual numbers and rather than the promises. So whether you want to keep it in your watch list, start with a small position and build gradually, or take a high conviction bet, the most important thing is to keep tracking the execution quarter after quarter. Well, let me close this video here. Now I'd love to know your take on RK Forging. Do you find it promising or not? If you find this video useful, do share it with your circle. I'll see you next video. Till then, take care.